Hey, it's Daniel Peterson coming in from my office. Today we want to talk about Roth conversions. This is a conversation that's really important to have and explore before December 31st, 2020. So we're going to talk in this one about Roth conversions when we've got excess or itemized deductions that are larger than our standard deduction. So come on back to the office and we're going to have a detailed conversation on this. Now let's talk about a situation where perhaps we've got extended care facilities for our elderly and pre-tax money sitting inside a 401k or an IRA that we have control over and can move or distribute that money or roll it over in a Roth conversion. Perhaps these first few years we've got other resources that we'll be utilizing to pay for that extended care. So we're anticipating that our itemized deductions will be larger than our standard deduction. Remember, for married filing jointly, the standard deduction is $24,800, plus we have some additional bumps for those situations where we're over 65 or blind. Keep in mind that our standard deduction amounts for married filing jointly, head of household, and single can be exceeded if we have other itemized deductions. In a situation where we have medical expenses, perhaps extended care facilities or other out-of-pocket medical costs, it may result in us itemizing deductions. So in the Roth conversion conversation, let's talk about our elderly folks who happen to be in a nursing home facility that's required for their medical care. They're going to be in a situation where they can itemize deductions. So if we have itemized deductions for our elderly folks, we have the ability to increase the amount of IRA or 401k that we either distribute or perhaps convert to a Roth IRA if we have other resources available to us to pay for that extended care. So imagine a situation where we're married filing jointly, we've got $36,000 of gross Social Security income, and we only have taxable or total income of $300 beyond that. None of our Social Security is taxable in that first year. But we've got $70,000 of itemized deductions between our charitable contributions, our real estate or income taxes, sales taxes, and our medical expenses. Well, we can modify that and better utilize those deductions by generating taxable income. How do we do that? We convert money to a Roth IRA or withdraw that money to be able to pay for the care. When we do that, in this situation, we're projecting $40,000 of income from a Roth conversion or withdrawal of an IRA. More of our Social Security becomes taxable when we generate that other income. So our total income's $58,455. Well, that reduces the amount of itemized deductions that we can deduct, and so we're only able to deduct $69,700 of our itemized deductions. Still, we have negative taxable income. If you can get your planning done properly, you can put yourself in a position where you've maximized the amount of IRA or 401k money that you've withdrawn against the deductions that you'll be able to claim in your itemized deduction world. In this case, we took $46,000 of IRA money and pulled it out. That exposed an additional $23,000 of our Social Security to federal income tax and then reduced our itemized deductions to $68,871. Well, our taxable income is only $684, generating a tax of $69. So if we've got situations where we've got elevated itemized deductions in a particular year, it may make more sense to either pull those resources out or convert those resources into a never tax bucket of money. If this particular individual or couple has children who are in their high income tax earnings years and they're in a higher tax bracket, it only makes sense to move that money while mom and dad have the ability to pay little to no tax. And so when the kids inherit that money, there is no tax. So in our single individuals, again, we recognize that that standard deduction exceeds or is smaller than our itemized deductions. Our itemized deductions are larger because we're staying in an extended care facility for rehab, for whatever the case may be. but we've got IRA money set aside, and we're using our other cash reserves to pay for that extended care. So our total income is $300. Yet our itemized deductions total $70,645. We're missing an opportunity to move money and not pay tax. So imagine we take and do it partially. We pull $40,000 from that IRA. Then we've got $24,000 of our Social Security income. Only $20,000 of that is subjected to tax. So that puts our total income at $60,355. Our itemized deductions are then reduced because of some limitations, but we still have negative taxable income. If the planning were done properly, you could pull $50,000 from that traditional IRA or 401k and expose that to tax. Then $20,400 of your Social Security is exposed to tax, generating a total income of $70,700. Well, your itemized deductions are then reduced to $68,785. So your taxable income is $1,915, generating a tax of $191. If we can plan properly for those life changes and those events that happen, we can move pre-tax bucket of money to a never tax bucket of money and pay very little to no tax.